Now, traders at Axis Bank expect the T-bills market to continue trading bearish due to tight liquidity. Now, for the bond side, improved bids are seen on the auction bonds following the postponement of this month's bond auction. Meanwhile, investors are trading cautiously as well in anticipation of the release of the August inflation data next week. Ladi Belo, head of fixed income at Axis Bank, joins us now for more market movements. Ladi, thanks a lot for your time on the show today. Now, let's start off the conversation with the liquidity position and how we are seeing trading pan out in the last few days.
Hi, good afternoon, David, and thank you for having me. Well, we are about 500 billion or just above 500 billion naira in the red. So the illiquidity in the system has lingered through till the latter part of the week, and that's why we've seen the market, especially on the treasury bill side, turn fairly bearish. So we've seen yields inch up gradually, especially on the one-year maturity, which printed around 18.59% levels on Wednesday. We've seen offers hover around the 18% mark on the same day, and this has inched up gradually to around the 18.45% levels today, with not a lot of bids to match. Within the mid and the shorter-termed securities, we've seen offers inch up on the short end from about 16% levels. We're firmly at around 16.5%. And on the mid-tenor securities, those February and March bills that were offered with high subscriptions earlier this year, are also offered around the 20% mark. So generally speaking, we've seen yields at elevated levels this week. Within the bond space, we've seen a similar trend, which took a bit of a reversal yesterday towards the end of the trading session, where we saw sellers of the on-the-run long-tenured maturity, which is the 2033, reopening. We've seen offers around 20.3% levels in the mid part of the week, but towards the end of this week, we've seen offers trend down given the expectations for lower rates as the shelf life on this particular maturity is coming close to the end.
Yeah, and now this is also the season of forecast as well. Now, let's have your forecast of what might likely play out within the FX space, how the Naira might trade against the greenback, your take around the likely inflation print, and how this might also be the next signal for the Monetary Policy Committee meeting, and even further signaling to how investors might position in the market.
Right, so the paucity of funds is no new news in the market. So we've seen CBN come into the market midweek again to intervene. They sold in the market, but this impact was largely unfelt given the huge demand that we've seen over the last couple of weeks and months as well. So we expect rates to hover around these levels pending when the CBN decides to intervene again. And as this has become a fairly ad hoc basis, we've seen that the band that in the parallel markets at which we're trading is around the 1650 mark. And by and large, the primary market tries to mirror that for the most part. But again, we'll continue to see this pressure on the Naira. And as a result, we expect to continue to see some depreciation of this against the greenback. And in terms of our inflation prints, in June 2024, we saw a 28-year high in the market, with inflation printing around the 34.2% mark. Following month, we've seen a reversal in this trend. We're currently at around 33.4%, but rightfully mentioned, we've seen the base effect kick in, and we should expect to see this level of inflation continue to taper. We shouldn't get too carried away because the increase in PMS would obviously have its own effect at further months down the line in the year, where we might see a bit of a reversal again. But generally speaking, the trend of inflation is likely to trend downwards in the longer term. As far as the MPC is concerned, which would meet towards the end of this month, we've also seen, because of this lower trend in inflation, we should expect to see the Monetary Policy Committee maintain all policy levers, which is in line with market expectations as well.